Stocks right now are mixed, with the NASDAQ trying to pull away as bonds rally big and the dollar drops. Investors' minds pretty focused on the FOMC next week. John Kosar back with us from Asbury Research. He's the chief market strategist. John, welcome back. Firstly, we always like to track your indicators. And the last few times we've talked, it seems like we've always kind of been on the verge of potential change, and the market kind of seemingly reflects that. It's like every time you and I talk, the S&P is still stuck at 4,000. Are we ever going to get away from that level?
Eventually, yes. You could really see what's going on when you look at the S&P 500 chart. This past 4 months, the market doesn't know what to do. I mean, it's pretty obvious. We've been drifting sideways since the beginning of December. We had a breakout in January in the S&P 500. On January the 23rd, we broke through the 200-day moving average, through the trend line from the January 22 highs. Got up to a little bit higher by the beginning of February, and now we've come right back in. There's that chart. So there's two important takeaways here. The first one is note that since the beginning of December, we've been drifting sideways. The market isn't quite sure of what to do here, and you could really see it in the sector rotation. We're in technology 1 week and we're in healthcare the next. A lot of consternation about what's happening to the economy, what's going on with inflation, where are we going next year? There's all these cross currents, and then of course we had the issue with the banks. So that just basically threw more gasoline on that fire. This is a big support level right here for the S&P 500. You can see we had the breakout on Jan 23rd. Now we've come back and we're sitting right on the trend line from 2022. And then you've got some Fibonacci retracement levels that are right there. The level is precisely 3850 to 3762. As long as we stay up above there, and we are now, this could be a potentially very good place to re-enter the market. The risk reward down here is extremely good, because if this support does not hold, I think we go back to the lows that we made back in June and October of last year.
Okay, so as it pertains right now, with your factors, your six that you follow, when we spoke back in mid-February, they were starting to veer a little bit positive, but they weren't like screaming, go out and buy, yeah. Right? So have we pretty much held since then, I guess? Or has anything changed in terms of your recommendations?
No, that's what's missing. The Asbury 6, 5 of the 6, actually all 6, you can see all 6 are red. 5 of 6, I think, were red a day or two ago. But generally speaking, most of these are in solidly negative territory. Wow. They've been there since February the 21st. So yeah, we're sitting on a really important support level in the S&P. We're sitting on a multi-year support level in the Russell 2000, but the internals are still weak. These internals need to strengthen up a little bit before it becomes safer to go back into the water. If you're a risk-reward player and you want to lean on this support and hope for the internals to get better, that's one way to play it. The safer way to play it is to wait for the market to recognize that there's a little bit of stability, a little cooling off. You want to see the VIX come back down, maybe back down under 22. That would be the safer place where the market is accepting that things are starting to get a little bit better, starting to cool off a little bit. And at that point, I think it would be a little safer re-entry into the markets from our risk-off 2/3 through February.
Okay, so the internals and the kind of fundamental metrics that you're watching certainly are not screaming to buy, but the technical setup looks like it could be such a payoff if it works. If you're a little bit of a risk taker, the technical suggests maybe you could dabble a little bit. How do we know if it's not working? We go back under that line?
Yeah, I mean, that support was very well defined. If we break through that little bar that was on that chart, obviously for that to happen, or not obviously, but the Asbury 6 would have to remain negative. So in other words, you never got that calming, where corporate bond spreads are starting to narrow, where there's more money going into the spiders, where market breadth is getting better. So through that level, again, the bottoms, it's 38.50 to 37.60. Through there, we go right back, I think, to that September 2020 high. You see the marking for that on the lower left. We actually tested and held that in June. Tested it again on September 30th. We broke through it for one day on October 13th. You can see it at the bottom of your screen. That's the risk right now. If you buy here and the internals do not get better, the Asbury 6 stays red, then I think we're looking at a retest of those lows. And from there, who knows? I mean, this is a really, really important inflection area here. Like I said, you've got the risk reward here. You don't have the strengthening internals yet.
Okay. The Russell, the small caps, looking a little weaker related to the bank stuff. Technically, does the Russell look to you significantly different from what's going on? I mean, can these indexes go in very different directions, or do ultimately they line up?
They do line up. The difference with the Russell is the support that the Russell is sitting on is much more long-term. You can see it on the chart. It's based on the highs that we made in October the 2018th. Of August 2018, January of 2020. That levels from 1742 down to 1750. 1742 to 1715. We've been all over that for the past 3 or 4 days. The market sees it. It's the 5th time that we have tested that since May of last year. If we go through there, and I look at the Russell as kind of it's a higher beta, a higher risk, maybe is a better way to put that, way to trade the market. When people have more risk appetite, they tend to go into small cap rather than maybe the safer S&P 500. So if we break through that level, you can see you don't have anything underneath there. So that's a level that's on my screen all day. I'm looking at it all day. If we break through there and for more than a day or two, for more than just a few index points, to me, that would be a leading indication that we've got another shoe to drop here, which could take the S&P back down to that 3,600 level. So again, screaming inflection point. Again, if you're looking at this from risk reward, very, very, it's either the market's got to get in gear here, or it's vulnerable to a pretty significant fall.
All right. Thanks, John. Love the charts. Really good stuff. Very make or break style situation seems like we're on right now. And the Asbury 6 indicator still red internally, so some reasons to be on alert. Appreciate it, John. Thank you very much.
Good to see you. Thanks.
Likewise, John Kosar, Chief Market Strategist at Asbury Research.